Let's get back to the analysts' views on reporting season, and for that, we're welcoming Sean Fenton from Sage Capital to join us live via Skype. Sean, boy, there's a lot happening out there. Safe to say that you can't really look anywhere without seeing COVID-19 still being referenced and the uncertainty relating to that.
Yeah, definitely. It's playing out right across the market. We've seen a range of companies being impacted by, particularly in Australia, the new lockdowns we're seeing. Obviously, not just in New South Wales, but Victoria and elsewhere as well. So, ranging from building material companies like Boral, to a lesser extent Adbri, both reference that weakness. We've had a couple of travel companies report this morning. So, Qantas and Flight Centre, both making big losses as their businesses really shut down, but starting to see some improving trends. You're seeing still big shifts in patterns of spending. You're starting to see Woolworths this morning noticed that you're starting to see shopping pick up again as people are locked down at home. So those impacts are still flowing through the economy. You mentioned Ramsay before, so obviously Ramsay elective surgery is being impacted by lockdowns again, so they're seeing another impact going forward. So very hard to avoid those lockdown impacts, which makes it tricky for investors to look through that, see where value lies, and obviously a lot of winners out there as well. AP Eagers reported this morning that second-hand car market remains very tight, earning great margins and record profits. So a range of winners and losers driven by COVID and still unsettling markets.
It's really difficult, I think, for investors, to your point, Sean, because we've heard about all the strength in the property market, for example. We've heard about all the infrastructure spending that is happening, that is to come. But, even just in Adbri's result yesterday, again, some caution being flagged, and they haven't shut the lights out.
No, it's still a very tough market. And those construction materials, you see it at Boral and aggregates, Adbri and cement, they're pretty competitive markets. And we really haven't seen non-residential construction infrastructure really tick up. So we're coming off the back of that mining boom that we saw 5-6 years ago, and that activity hasn't really got back there, and infrastructure spend really peaked out in 2019. So even without big government packages there, it's a bit of a struggle. Adbri is facing increased competition on the East Coast from new players in cement. They've lost some of their lime contracts to Alcoa. Similarly, Boral, some of that pricing on aggregates and cement, those big projects can be quite tight as well. So we're not really seeing much strength coming through that part of the economy. It's really been about house prices, as you say, single family homes, people wanting more space, moving to regional areas. So that house construction segment, the beneficiaries there, a little bit more James Hardie. You've got the same dynamic across the US. CSR here as well, probably a little bit more positively impacted by some of those trends. But infrastructure's still been not weak, but has been not really hitting new highs.
So we've heard from most of the big miners, still waiting to hear from Fortescue. We know about the strength that we've seen in the iron ore price. We know that we've seen it pull back. I mean, a little bit of a bounce back in the past couple of days. What is your sense that we have seen a correction happening in the price of iron ore, or is it the end of the cycle? How does that, if I can continue on, make you think about investing in those big miners versus some of those companies that are still leveraged to the very strong steel demand, for example, that we're seeing?
Yeah, it's really interesting time for iron ore miners because they've just been printing money, literally. So they've been generating massive free cash flows and paying out huge dividends. And over the last month, we've seen the iron ore price collapse from over $200 a tonne to $140 a tonne. So a big pullback. But at the same time, they're all paying out big dividends and big capital returns. So really tough time for investors. But we have started to see those stocks roll over, come under pressure. We've seen some of the discounts for lower grade iron ores like Fortescue Mineral Resources produce increase and lump premiums reduce as well. So tough time for investors, but it does look a little bit more like the top of a cycle as opposed to just a short-term correction to us. And that's really driven by two things. One, change of policy in China. They're focused on actually reducing steel production this year after surging post-COVID, and in the years leading up to that, that's partly environmental, partly rebalancing the property market. You've seen total social financing roll over within China, which is a good indicator of the property market and construction as well as infrastructure spend there. So that's all slowing. You're starting to actually see a few warning bells ringing in China. You've seen risk of insolvency from Warring Bank and Evergrande as well, which large property developer, which is sending a few shockwaves through investment markets there, and combined with things like land sales being weaker, means the outlook for property construction is probably softer in China. They're looking, they've removed export rebates, they're looking to wind back exports, and you've probably seen the global manufacturing rebound peak out as well. So we see a period where China's steel production is probably peaking out and starting to ebb just as supply catches up as Brazil and Vale start to ramp up the second half of this year. So weakness for iron ore, but that dynamics, as you say, interesting for steel makers because China looking to pull back from their export markets. You're still seeing very high steel prices around developed markets and steel making margins from electric arc, so using scrap and rebar, so using scrap there for the electric arc furnaces, so like BlueScope in North Star in the US, Sims, both benefiting from high scrap prices and really high steel making margins. And while China's pulling back from export markets, that's more likely to be maintained. So also generating massive free cash flow. And with those shifts in market balances, probably more likely to be maintained. So they really got pressured by big exports from China over the last decade, and that's probably normalising going forward. So they're over-earning at the moment, but we see that profit as being more sustainable long term.
Very quickly, Sean, I would just like to know what you've been buying or what you would buy now that you've seen some of the, well, I guess the majority of companies reporting.
I think at a reporting season, the insurance sector probably stands out as an interesting area to buy. You look around the market and everything's trading at record highs and been booming along, but the insurance sector's been under pressure for a while, and we're seeing that cycle really start to turn. So global insurance premiums are moving up at double-digit rates. The domestic market's been a little bit slow to respond, but that's been picking up as well. So QBE is definitely one of our preferred stocks, and we've been buying that post results, as well as the general insurers. Steadfast we quite like as an insurance broker as well, really benefits from that premium uplift and consolidation of the market. So that's a sector that is still looking pretty good value, leverage to top line growth, and also eventually if we ever get some policy normalisation, higher bond yields and cash rates, then investment income can start to pick up for them as well.
Sean, thank you for being so generous with your insights and your time. We do appreciate it from Sage Capital.
Thank you.